Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveny. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode of the Creating Wealth Simplified podcast. I am your host, Chris Seveny, and today I want to share a few more case studies with investors. So recently, I was talking about a loan that we had a borrower in a situation where they hadn't paid in several years, and this property was not their owner-occupied property. They're using the property as a rental. And I think I made the comment that they were essentially a professional borrower, meaning they clearly knew how to game the system. And in this situation, we had gone on for 3 or 4 years with this borrower. And I want to say 4. And, borrower filed multiple bankruptcies, went through multiple mediation. And finally, the borrower, after never making a payment through any of these bankruptcies, it got tossed. And the borrower went to file another bankruptcy. And the court said, sorry, but you can file bankruptcy, but the property in question is no longer protected as part of the bankruptcy. So after that occurred, we continued on with our foreclosure. And here's kind of a little strategy thing that a lot of people, when they go to note investing, they're like, oh, it's black and white. And, here's the reality of this situation. We've never stepped foot inside this property. This property could be worth anywhere from, call it $70,000 to $120,000, depending on the condition. The borrower owed roughly, call it $80,000, $90,000 on the loan. Again, using rough approximations. But now here's where you have to think. If I bid $90,000 at foreclosure and I take that property back, okay? I just essentially bought that property for $90,000 because foreclosure is an auction. I don't want to keep that property. I'm going to turn around and sell it. So what would I need to do? 1, I'm writing this stuff down so I remember. File eviction and get that person out of the property. 2 things that would include or cause: time and money. Okay. We'd have to go evict them. Next component is then I have to turn around and sell this property. I have to get it cleaned out because I know it's not going to be left in a nice broom swept condition. Well, get that property cleaned out. Going to want to change the locks. We're going to have to get a real estate agent involved. We're going to spend, I'm going to say $5,000 cleaning out that property. Then I get an agent, and I'm going to have to pay, rough numbers, 6% commissions, other closing costs and everything else involved. Say it's 8%. So now the question is, what's the magic number somebody should bid on at auction? Because if you're not wanting to take the property back, you have to realize that if I let it sell for auction at, here's an example, $70,000, or take it back at 75, which one is better? The long run, you'll be much better off with the 70 than I'll say the 75, just as an example. Let's use that 90. Okay, so if I take it back for 90, and let's say I sell it for 90, going to say sell it for what I took it back for. Usually it's less because nobody would pay that. The 8%, $7,200 plus $5,000 to clean it up. And let's say $1,000 for eviction. $13,000+ already spent. What's that other factor that I mentioned early on? Time. Time is money. If you wanted 10% annualized on your money, an extra $750 a month that this thing's churning. And by the time you go through the eviction and everything else, you're, easily 6 months, which again is another $5,000. So these are the things that as an investor, I want to share with those who actually, want to be involved in note investing. But as somebody who manages a portfolio, these are the things you got to think about. $90,000 at foreclosure auction isn't the same as $90,000 taking back. If I can get $90,000 at auction, that is far better. Now, give some idea and some insights. I think on this loan, just going to use rough numbers into it for $35,000, $40,000. So definitely was going to be some money made on it, just a matter of how much. So when it goes to auction, what do I want to focus on? I did not want to take this property back. In knowing, that range of values where it could be, I started at the low end. And I started our bid in the low 70s. And somebody bid and won the auction. And again, I reverse engineered it again to say, am I happy with that? And yes, I was, because I no longer have to deal with the property. I'm going to get paid off at auction. I don't have to evict. I don't have to clean it out. I don't have to do any of that. So it's done. Now let's talk about another asset that had in our portfolio previously, where this one borrower had tons of equity. House, $250,000, $300,000 house, and they owed 100 and something thousand. Property went to foreclosure, and we bid full payoff, and somebody came in and bid well above that, which is great for us because in Michigan, where this was, there's a redemption period. That person can't do anything for 6 more months, but we get all our money. So just wanted to share those. And then we have another interesting situation where we had a loan that, basically we're working on foreclosure and, also trying to work what's called a deed in lieu with the borrower. So a deed in lieu with the borrower is, hey, look, let's just cut to the chase, not do the foreclosure. You don't want the property, which they don't in this instance. Just give us the title to the property. And, in order to do that, we have to be very careful. We have to check there's no other liens or encumbrances on that property, because if we take the deed, it's quit claim to us, and we'd be responsible for all those. Thankfully, we've, done all that research. We've done that due diligence, and no other liens on the property. The challenge we're running into is we have a borrower who is not very receptive to giving a deed in lieu. And the borrower has come back and has wanted tens of thousands of dollars from us for a deed in lieu. So how do we evaluate the situation? And if you're a note investor, how do you evaluate this? And let me explain. Kind of, what are the options or what are the outcomes? That's how I always look at things. What are the outcomes that could occur? We can foreclose. And if we foreclose, we pretty confident we'll take this property back because the valuation is close to the total payoff. And there's some benefits, we believe, in taking this property back to put it back on the market and to potentially get some surplus from it. So first thing is, how long is that foreclosure going to take? So this is in a non-judicial state, which means you don't have to go through the courts. It's going to take, about 60 days. So we could foreclose in 60 days. It's going to cost us $5,000. Rough numbers of foreclose. Or, we can try and get the property back today. And what's that property worth today? Or how much should we give this person? Do we give them 5,000 that we give the attorneys? Do you give them a little bit more? But if he came back and said, I want 50,000, you give him 50,000, or do you wait 2 months of time? Those are the questions that you have to evaluate and understand. And as a note investor, for many, and I had this early on and completely, doesn't even phase me anymore, is early on, you look at it as there is no way I'm going to give somebody who's not paying their mortgage money to walk away. They should be giving me money, is the way you think about it and the way you look at it. Well, unfortunately, it's not reality. It's not how the business works. And you have to take all your differences, separate everything, and focus on what is the best outcome for me and my company. Now, in this instance, giving him $50,000 is not the best outcome. Pushing it through to foreclosure, is a better outcome because of what it will cost us in that time. Now, if this was a 2-year foreclosure process and the costs were $20,000 to foreclose, that would be a much different conversation or a much different analysis. But what we have in front of us is very definitive, very defined. The borrower, we know, is not going to file bankruptcy. Actually, the borrower has passed away in this instance. The estate is not going to file bankruptcy. They could, but we would still push to, try and get the property sold because they've already said they want no interest in this property. So what is the magic number? This is the question that people have to think about, in the gray areas I always mention about what we do in note investing. What's the best to provide or to get in order to secure the property, which is one thing that we absolutely want to do. We want to take control of this property because we want to make sure it stays vacant. We don't want squatters in there. We want to make sure utilities and things are on so we don't have floods, leaks, fires, whatever the case may be. So another thing to focus on is eventually we're going to take this property back. So let's try and get it sooner rather than later. Because if we can get it back sooner, quicker we can get it on the market, quicker we can turn it over. So another situation, another potential outcome that people have to look at and try and resolve. And there's a lot of people out there who will show you black and white of note investing, but there's so much in between in the grays that this needs to be understood and resolved. And I do believe we will come to some type of settlement, some type of agreement with the borrower. We're not being overly aggressive with them and basically, emailing them back and forth. We're reviewing to see what works for us, get back to them, review the numbers, because time is more on our side than it is on their side. So it'll be an interesting outcome that we can share in the future once it gets resolved. It's something that is still ongoing and something we are still evaluating, still looking at, and trying to, see where it goes. Those are 2 case studies, or 2 active loans. The third thing I want to talk about is a recent loan that came across our desk that we turned down. And one of the things that, as a sponsor of a fund, as well as an investor in other funds, people really need to pay attention to and be aware of is, call it sticker excitement. And what do I mean by sticker excitement? Is look at the potential on an opportunity and basically, oh my God, that is an awesome return. We had an opportunity, someone was, for to acquire a loan that essentially is paying, 20%. It was newly originated. And, we would be able to collect, some points on it and, 15% interest on this loan. So it's 20%. And looked at it and, we go through a very thorough due diligence process. And one of the first things that kind of kicked it out for us was that it was a highly leveraged second position loan. And typically, do we have some seconds in our portfolio? We do. It's not, what our main focus is. And we always evaluate, the underscore the risk in these loans. But this individual, basically it was probably leverage up to about 90%. And we, quickly looked at it and said no. And they asked us if we knew anybody else. And there's other people who will lend on this and who are happy to, take on this type of risk. And I share this story because in today's environment, we're seeing, I'm very active on Bigger Pockets, seeing post after post after post of people investing in syndications that were promising 15, 20, 25% plus returns. And the reality is, one of them, somebody took a poll and actually showed how many people invested in this opportunity. And the majority of them invested when the returns went from like a 12% to investors to like a 20% return to investors. And for me, the first question I'd ask is, what change as part of your business model that allows for that type of return? What is my risk profile? What am I looking at? Like, what are you investing in? And unfortunately, many people threw in six figures of income, no idea what they're investing in. And the sponsor freezes distributions, stops paying. And now people are shocked, like, oh my God, okay, I'll get all my money back or whatnot. And reality is, it potentially could be nothing there left, because when somebody's trying to target such a high return, bringing in all that money, it is a high risk investment. Now, that's not to say there could be some low return investments that aren't high risk. Every investment has significant risk in it. But if somebody's trying to target a return that is significantly higher than the marketplace, then you have to understand your risk premium is going to be significantly higher. So your standard deviation, which is, where that fund could finalize and perform, could perform really well and give you that, but it also could perform down to zero as well, because of that type of opportunity. So other things people really need to focus on, really need to consider as part of investing in the space is not just get so excited by, wow, this person's offering this percent return or that percent return, because that's not guaranteed. That's not promised. That is a target. That's what they're aiming for. And the question should be, what needs to go right to get there? What could potentially go wrong? And what is this risk profile that I'm looking at? So hope everyone enjoyed this episode of Creating Wealth Simplified. As always, make sure to leave us a review, either Google or on your favorite listening station. If you want more information about the company, head over to 7einvestments.com. Thanks for listening. Take care. Enjoy the rest of your day. And we'll continue to keep you updated on these case studies and more about how to invest in mortgage notes. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.